Hello and welcome. Jason Weaver here from Weaver Consulting Group. Welcome back for December's 3 and 3 video, our latest market update of 2025. Today we're covering 3 topics under the theme Longer for Longer. First, why interest rates are staying higher. Second, why inflation is stuck above the target. And third, how tariffs have become a massive revenue source. Let's start with rates. The Fed cut to 3.5 to 3 3/4 in the overnight rate in December, their third straight cut. Chair Powell's key message: we're well positioned to wait and see. Translation: don't expect many more cuts. The Fed projects only 1 rate cut in all of 2026. That would bring rates to 3.25 to 3.5. Markets were expecting 2 or 3 cuts, so there's a potential disconnect here. Here's what matters. Current rates aren't actually high. From 2000 to 2007, rates typically sat between 3% and 5%. The near zero rates from 2009 to 2021, those were actually emergency measures. The Fed now says the neutral rate is around 3%. That's where rates neither help nor hurt the economy. So as you're looking at this chart here, you can see that the market is expecting within 100% probability of 1 rate cut in January of 2026. As we move out to March, there's a 53% that we'll have actually by then 2 rate cuts. As we look out to June, potentially again the 3rd rate cut. Now as you look at the end of the year, there's only a 41% chance the market is expecting that 4th rate cut. So most likely we're going to be somewhere in between 2 to 3 rate cuts for 2026. So why aren't long-term rates coming down? Inflation is actually sticky. We peaked at 9.1% in June of 2022, the highest in 40 years. We've dropped to 2.7% as of November. That's great progress. But getting to the Fed's 2% target, the Fed says that won't happen until 2028, 3 years away. So why so persistent? Services inflation, haircuts, healthcare, restaurants, they're running at about 3.5%. You can't offshore a haircut. American workers cost more, so services cost more. Housing costs make up about 36% of inflation, and they're at 3%. Better than before, but still high. Many economists now think 3% inflation is the new normal, not 2%. That pushes prices up, bringing manufacturing back to America, baby boomers retiring, less global trade. Those aren't going away anytime soon. So let's look at this chart of inflation. And you can see core CPI is at 2.6%. If we look at the major components of inflation, when it comes to the higher amounts, you can see energy is at 4.2%. You've got, again, household furnishings and operations at 4.6%. Used cars and trucks at 3.6%. And on the lower end, you've got new vehicles and apparel. One thing that's hurting most Americans is actually those food costs. So we're not expecting those to come down anytime soon also. Now let's talk about tariffs. Tariff policy has changed more dramatically than any time since the 1930s. Tariff revenue jumped from $77 billion in 2024 to $195 billion in 2025. That's up 253% in 1 year. Average tariff rates went from 2.2% to 17.9%, the highest since 1934. Major tariffs include 100% on Chinese electric vehicles, 50% on semiconductors, 25% on cars. Why does this matter? Tariffs are taxes on imports. Companies pay more to bring stuff in. They pass costs to consumers. That pushes inflation up. But here's the other side. Tariffs now bring in 3.5% of federal revenue, up from 1.2% in 2017. That's nearly a $200 billion in extra revenue. The government needs this money now. The Supreme Court rules on tariff authority in early 2026. This could force some refunds, but most analysts think tariffs stay because the government can't afford to lose the revenue. So this chart shows the story. We started at $35 billion in 2017 in tariffs, grew to $71 billion by 2019 during the first trade war, hit $100 billion in 2022, and Biden kept most tariffs in place. But look at 2025, that spiked to $195 billion. The table shows it clearly. We averaged $35 billion pre-Trump, $78 billion during Trump 1 and Biden, and now we're at $195 billion. This isn't going back. Even if courts strike some down, the baseline is permanently higher. That means higher prices on imports are here to stay. For most investors, this affects inflation and company profits. Importers face higher costs, domestic manufacturers get more competitive. That wraps up our last 3 and 3 for 2025. Thanks for watching and happy holidays. For questions about your financial plan and the new reality, reach out. If this was helpful, like and subscribe for our 2026 updates.